If you're spending money on marketing and you have no idea if it's actually making money or not, this video is for you. Because if you are unable to track your marketing ROI, you're going to start to see problems and you're going to probably find yourself saying the following things. It feels like I'm flying blind with my business growth. It feels like I have an inability to scale and grow my business without being fearful. It feels like I'm making decisions based off gut, which is obviously dangerous. And it feels like marketing is just a cost, not an asset, and I'm starting to lose trust in marketing. These are the things that you probably found yourself saying if you are not tracking your marketing ROI correctly. But when you start to track your marketing ROI correctly, what you'll find is that you'll start to make decisions calmly, not reactively or emotionally. You'll know exactly what to scale and what to cut out. You'll be able to hold partners accountable to revenue, not activity. So these are your suppliers, marketing agencies, your CMO, anything like that. And finally, you can now start to forecast revenue from your marketing activities, which is super powerful. So my promise to you is that if you watch until the end of this video, you'll know exactly how to track your marketing ROI like an absolute pro. So let's get into it. And as a bonus, if you watch until the end of this video, I'll give you a free ROI marketing dashboard, the same dashboard that we use with our clients for you to track your marketing ROI. So with that being said, who am I and how can I talk about this? Hi, my name is Farah. I'm the founder of Future Famous. Future Famous is a digital marketing agency. We specialize in lead generation. We were established in 2019. We're based in Sandton, South Africa. We've worked with over 125 South African brands in the last 8 years. We've been able to generate over 250 million rand in tracked revenue, 5 million leads, 2 million rand in ad spend every single month, and we have generated over 20 plus 7-figure campaigns. So now that you know that we are at least a little bit uniquely qualified to speak about this topic, let's dive into how to actually track your marketing ROI. And this is also how we track marketing ROI for our clients. Let's jump straight in. So when you're tracking your marketing ROI, you should answer two main questions with this activity. The first question is the current campaign working or not right now in the short term? So simply put, the current campaign that I'm spending money on, is it working? And the second question should answer more of a long-term question, and that is this a sustainable long-term way to grow the business? So we're going to be diving into both methods. So starting off with number one, in the short term. So what we have found is that there's 3 levels of marketing ROI. The first level is money in versus money out, and this is what we track majority of the time for our clients. So the formula for this is revenue divided by advertising spend. So just an example, you spend 10,000 Rand on your ads, you generate 100K, that gives you an ROI of 10x. So we get a lot of pushback with this with our clients because they say, yes, I spent 10,000 Rand and yes, I made 100,000 Rand, but that's not my true returns because, what about gross profit? What about my operating expenses? What about my sales team? Things like that. And what I'm going to do is basically explain that to you a little bit later. And it's not that when we track this with clients that we're trying to be deceitful, not give them the full story. It's just that this is the simplest way for you to track your ROI at level 1. And if you can't even get a positive return at level 1, what's the point of worrying about level 2, level 3, or worrying about profits? So why we track this with our clients is because if we can at least get to level 1, it doesn't mean that the campaign's not going to be profitable in the future and it's not going to result in long-term growth. Just as an example, the function of level 1 ROI marketing, money in versus money out, is tracking revenue generated from a campaign as an indication of future profit potential. So what that means is that, yes, you spend 10,000, you generate 100,000 Rand, it looks good on paper, but is that taking business margins into account? And that brings us to level 2. The next formula is ROI on gross profit. So the formula for that is gross profit revenue divided by advertising spend. So basically, how much gross profit did you generate from this campaign in correlation to your advertising spend? So the same example, you sell a 100K service, your gross profit is 70%. So you spend 10,000 Rand, you generated 100,000 Rand, your gross profit is only 70%. So that means your ROI is 7x. So the thing with this formula is that if you have an ROI of 7x, is that good? Is that bad? That is obviously very subjective, and I'm going to be answering that in a later stage of this video. In saying that, the function of this is to track gross profit generated from a campaign. So this is a very, very good indication for businesses like B2C service-based businesses where you have a customer come in one time, they don't really ever come back, you make money off them once and that's it. So this is a very good formula for you to track, I'm actually making gross profit off of my marketing. So this is for tracking gross profit generated from a campaign. The third level. Now, I put this on here, but this is what everybody wants to eventually get to. But if I'm going to be honest, that's a bit of a thumbsuck number. I would say 1% of businesses are part of this formula. In all my experience at Future Famous with working probably with 150 brands, I think we've had 2 clients that have ever gotten to this level. And this level is ROI on net profit. We do this for a living. We've actually never even gotten this right ourselves, but this is what you can aspire to be. So this is when you have such good marketing that your cost per acquisition is so low and you have such a good product that people buy it for a high price, or when they buy it, they just stick and they pay every single month and they don't churn. That's obviously very rare in business. I mean, my business is not like that. It's not very likely that your business is like that. So the formula for this is is your net profit made on a customer divided by your total advertising spend per customer acquired, known as your CAC or your CPA. So it sounds very confusing, but I'm going to simplify it now. So how this works, coming back to the example, you sell a 100K service, your gross profit is 70% and your net profit is 15%. So if we look at our example, you spend 10,000 Rand, you generated 100,000 Rand in revenue. Remember, your gross profit was 70%, but this time we're going to be working out our net profit. Your net profit was 15,000 Rand. 15,000 Rand divided by 10,000 gives us an ROI of 1.5x. So in the first example, for every 1 Rand you spent, you generated 10 Rand back in revenue. In level 2, for every 1 Rand you spent, you generated 7 Rand back in gross profit. And for level 3, for every 1 Rand you spent, you generated 1.5x in net profit. Is that good or is that bad? And I'm going to explain that to you now in a second. So the function of this is obviously to see if your marketing is profitable so that you can scale your current funnel fast. So full transparency, like I said, this is so rare. Like I would say 1 to 2% of businesses fall in this bracket where they spend money in marketing and it's profitable on net profit. At this point of the video, you might think, okay, cool. Well, I know how to work out my marketing ROI. I know that there's 3 levels. Level 1 is revenue, level 2 is gross profit, and level 3 is net profit. That all answers marketing in the short term. So you spend money on a campaign, you get money back, and that's obviously a quick feedback loop for you to make decisions. But now, if you just make decisions based off that, it is quite short term, to be quite honest. What you need to do is, if you are part of level 1 or level 2 or level 3, fantastic, because most businesses don't even get to level 1 in full transparency. What you then got to do is leave it for a while so that you can start to build up data. When you have gotten to a point where you've ran this campaign for, let's say, 3 months, 6 months, a year, what you'll then be able to do is you'll be able to answer the question, is this marketing campaign sustainable for the long run? So question number 1, is this current campaign working or not right now in the short term? If it's part of level 1, level 2, or level 3, it is. But now the next thing is this a sustainable long-term way to grow the business? And how we work this out is you need to know 2 numbers. And in my opinion, these are the 2 most important numbers in business. And that is number one, your customer lifetime value. So how much money do you make off a customer over the entire duration, or how much money do you make off a customer within a certain time period? And the second is, what is your cost to acquire one customer, taking in all of your advertising expenses into account? So these are marketing, sales, software, your website, everything together to sell one customer. Long-term growth metrics to look at, if we explain customer lifetime value at a deeper level, how much revenue is generated from one customer over their lifetime. I like to look at 3 years, because what can tend to happen is, if you acquire a customer once, even if you are a once-off service-based business, what you'll find is that still customers are going to come back to you in the future, or there might just be a maintenance component to your business where a customer buys once and later they come in and buy smaller items. You have to take that into consideration, because if you don't take the customer lifetime into consideration, you'll find that you're going to be underspending with your marketing, which you don't want. That's why customer lifetime value is so important. So the formula for LTV is total revenue divided by unique customers, not total sales. So if you're a recurring based business, you don't work out the total sales, because that'll be your average order value. What you want is unique customers. So if you generated 100,000 Rand in revenue and you've had 10 customers, that would mean that your lifetime value is 10,000. Even if you've had multiple purchases, you want to see the value per one customer. Very important. The next then on the right hand side is your cost to acquire a customer. So what you want to do is you want to take your total cost of all marketing activities to generate one customer. So that is cost per acquisition, or CPA, some people might call it. That is your total advertising cost divided by 1. So now that you got that, I'm jumping the gun here a bit. Now that you have these 2 numbers, right? And remember, the purpose of this is to make long-term growth metrics off of your marketing ROI data that you have. Now that you know these 2 numbers, it's important to look at them in relation to each other. So your LTV to CAC ratio. So the formula for that is your lifetime value divided by your total advertising spend, which is your CPA or your cost to acquire a customer. So let's look at an example. Again, a customer is worth 100,000 Rand to you over their lifetime or over 3 years. You spend 20,000 Rand to acquire one customer. So in the previous example, I used 10,000 Rand, that was your ad spend. But let's say you don't have a salesperson, but let's say you have an agency retainer of 10,000 and that's your only marketing cost. You have to combine those costs together. So 20,000, all of your expenses involved in acquiring one customer divided by 100,000, that gives you an LTV to CAC ratio of 5x. Now again, on the previous example, is it good or is it bad? You know, it's hard to say for sure. This is how I answer it. So for the longest time, I used to believe that the magic number is 3. So the magic number is lifetime value to CAC ratio is 3 to 1. But then the more I got involved in business, and thanks to a guy called Alex Hormozi, what I realized is that this formula of just assuming that it's 3-to-1 fails to apply the ratio to the correct business type. And again, all credit to Alex Hormozi. I learned this from him because there are obviously 4 types of businesses. You have a service-based business, e-commerce business, SaaS business, info product business, and all businesses have different types of automation, different types of operating expenses, and you have to look at a business's operating expenses as well when it comes to marketing. So the golden LTV ratio rule for determining if 3-to-1 is good or 6-to-1 is good or 9-to-1 is good is how many steps in your acquisition process is automated. Is your marketing automated? So an example of that is that you run ads. There's no human element involved. An example of your marketing process not being automated is you do outbound. So you have a team that does outbound calls, they qualify the prospects, and then when there is a bite, they move it on to the sales team. So that's an example. The second is your sales process automated? So an example of that would be a SaaS business or a software business where you go to a website, you fill in your card details, and you sign up for a free trial, or an e-commerce business. Usually that process is automated. For most businesses like myself, there is a human person that's involved in the sales process. They hop on a Zoom call or they make a phone call to facilitate the sale. And then once the sale is made, is your ops process automated? So for example, if you're a SaaS or e-commerce, that's automated. Product gets delivered or the free trial starts online. But now I know that with all these businesses, there is an operating expense involved in all of them, but this is just looking at the acquisition journey and the acquisition process. Very important. To answer it for you, if all 3 of the business functions involved in the acquisition process are automated, then your LTV to CAC ratio can be 3-to-1. How interesting is that? If one is not automated and the other 2 are automated, that means that your LTV to CAC ratio is 6-to-1. So an example, you have outbound sales team in this example here, but then they're selling a SaaS service, so they get you to sign up to a SaaS and then the trial starts. That's an example of that. If 2 of the steps are not automated and 1 is, then your LTV to CAC ratio should be 9-to-1. So for example, this is myself. And remember, the order won't be like this. The order can be in any process possible. So we're an example of this. We run paid ads for ourselves. There's no human involved in that. But when someone does book a call, I hop on the sales call, I find out their needs, I pitch them on a strategy, and then when they do sign up, my ops team fulfills it, and that's obviously people doing that. And then finally, if none of the steps are automated, then you must have an LTV to ratio of 12. So what this shows is that you have to have such good marketing, and you have to have such a good product that people don't cancel for marketing to actually be super profitable and for you to scale. Now, the purpose of this, back to marketing ROI, is all we're trying to prove with this is your marketing efficiency. So so what's very important with the LTV to CAC ratio is that if you're a little bit off or you over, it's not that it's the end of the world and your business is going to go bankrupt and you're overspending, but it's just merely a metric, an ROI-based metric for the long term in terms of, is your marketing in your marketing now? Are you overspending, underspending, or is it perfect or optimized? And that's what this determines. So with that being said, that is how you work out your marketing ROI in the short term and in the long term. You can't have one without the other. If you just focus on the short-term marketing ROI, you're not going to know if you're actually acquiring customers that are staying for the long term. And if you just focus on obviously the long term, you might make very rushed decisions and not give your campaign enough time to generate data for you then to start optimizing. So there you have it. That's how you work out your marketing ROI. The next steps, if you want to do this process for your own business, what I want you to do is I want you to work out your short-term ROI. So are you level 1, level 2, or level 3? I mean, it would be amazing if you're level 3 or level 2. If you are level 1, that's also flipping incredible because like I said, most businesses don't get that. Once you know what level you are and you know that you're okay in the short term, the next thing would be to work out your lifetime value of a customer. So remember, take the last 3 years because that's a lot of data. Total amount of revenue divided by unique customers in those 3 years. Once you have that, take your total advertising costs and divide it by the price to acquire one customer. Then take the LTV and the CAC and work it out as a ratio. Once you worked it out as a ratio, then what you can do is see what ratio you should be at depending on how automated your acquisition process is based off the type of business that you are. And once you have done that, you will then see how efficient your marketing ROI is. And from there, you can make a decision, okay, cool, my LTV to CAC ratio is way too high. I'm going to be a lot more aggressive with my spending, or I'm spending too much, it's quite low, let me cut back, or it might just be perfect. If you do this, please do me a favor, comment down below on if your marketing ROI is, if you're overspending, underspending, or perfect. I'd really love to hear your perspective on this and if it made sense. And then also click the link below this video if you want to download an ROI dashboard to work out if your marketing is profitable in the short term. Click the link below. I'll take you to a landing page. Just put your information and it'll be emailed to you. Thank you so much for watching this video. I hope you enjoyed it. I hope it made sense, and I'll catch you in the next video. Cheers.